You are probably paying a professional fund manager to invest your money. And according to 20 years of documented data, there is a 92% chance they are delivering you worse returns than you would get from a simple, automated fund that costs almost nothing to run. That is not a guess. That is not an opinion. That is the documented finding of the S&P SPIVA scorecard, the most rigorous, most cited independent analysis of active versus passive fund performance ever conducted. Published by S&P Global, updated annually, available to anyone who wants to read it. 92% of actively managed large-cap U.S. mutual funds underperformed the S&P 500 index over the 20-year period ending in 2023. And yet the average actively managed fund charges between 0.5 and 1.5% per year in fees for that underperformance. While the average S&P 500 index fund charges between 0.01 and 0.04%. Today, I am going to show you exactly why that gap exists, what it costs you in real dollar terms over an investing lifetime, why even professional investors with research teams and Bloomberg terminals consistently lose to a fund with no human decision-making whatsoever, and the exact steps to move your money into low-cost index funds at no cost and no penalty starting today. Before we go further, everything in this video is for educational and informational purposes only. It is not financial advice or investment advice. Past performance does not guarantee future results. All investments involve risk, including possible loss of principal. I am not a licensed financial advisor. Please consult a qualified financial professional before making any changes to your investment accounts. With that said, let us get into the evidence. Let me establish what this costs most Americans in dollar terms before we look at why it happens. According to the Investment Company Institute, Americans have approximately $28 trillion invested in mutual funds. A significant portion of that is in actively managed funds. The average expense ratio for an actively managed U.S. equity mutual fund is approximately 0.68% per year, according to Morningstar's 2024 fund fee study. The average expense ratio for a passive index fund tracking the same category is approximately 0.06%. That difference, 0.68% versus 0.06%, is 0.62% per year. On a $100,000 portfolio, that is $620 per year in additional fees. On a $250,000 portfolio, it is $1,550 per year, and those fees compound. They are not just a flat annual cost, they are assessed on a growing balance, which means the absolute dollar cost increases every year as the portfolio grows. But the fee difference is only half the problem. The other half is underperformance. If active funds consistently charged higher fees but delivered higher returns, the math might justify the cost. The research shows consistently that they do not. The average actively managed fund, after fees, delivers lower returns than its benchmark index. Not in most years, but over the long periods that matter for retirement investing. This is not a fringe argument. It is the consensus position of academic finance research, government regulatory bodies, and the most sophisticated institutional investors in the world. The endowments of Harvard, Yale, and Stanford, which have unlimited research resources and access to every strategy available, have gradually shifted enormous portions of their portfolios to passive index strategies over the past 2 decades. If it is good enough for Harvard's endowment, it deserves serious consideration for your 401k. Let me walk you through the SPIVA data specifically, because I want you to see the full picture of this research. Not a summary, but the actual findings. The The S&P Indices versus Active, or SPIVA, scorecard has been published by S&P Global since 2002. It measures what percentage of actively managed mutual funds in various categories outperform their designated benchmark index after fees over 1, 3, 5, 10, 15, and 20-year periods. It is widely considered the gold standard of active versus passive performance comparison. For the 20-year period ending December 2023, 92.2% of U.S. large-cap actively managed equity funds underperformed the S&P 500. Read that again. Over a 20-year period, long enough to include multiple bull markets, bear markets, the 2008 financial crisis, the 2020 pandemic crash and recovery, and the 2022 rate hike environment, 92.2% of professional stock pickers lost to an automated index. For U.S. mid-cap funds over the same 20 years, 94.9% underperformed their benchmark. For U.S. small-cap funds, 91.7% underperformed. International funds showed similar patterns. Bond funds showed similar patterns. The performance gap also widens over time. Over 5 years, approximately 78% of large-cap active funds underperform the index. Over 10 years, approximately 88% underperform. Over 20 years, 92% underperform. The longer the time horizon that matters most for retirement investing, the worse the relative performance of active management becomes. The reason is structural and was explained mathematically by Nobel Prize-winning economist William Sharpe in his 1991 paper titled The Arithmetic of Active Management. His argument is not statistical, it is logical. Before costs, the average actively managed dollar and the average index dollar must produce the same gross return, because together they represent the entire market. After costs, the average actively managed dollar must produce a lower net return than the index dollar, because it carries higher expenses. This is not a probabilistic prediction, it is a mathematical certainty. But here is what nobody is telling you. The fee difference alone, compounded over a full investing lifetime, represents a sum of money that will genuinely shock you when you see it calculated. I am going to show you that number right now, and then I am going to show you the exact index funds that eliminate this cost entirely. And if this research is changing how you see your investment accounts, subscribe right now. We release financial investigations exactly like this 3 times every week. Everything is free. Subscribe so you never miss another one. Let me show you the full compounding cost of the fee gap on a real investment scenario. Person A invests $500 per month for 30 years in an actively managed mutual fund, charging 1% per year in expense ratio. The fund delivers the same gross market return as the index. Let us say 8% annually before fees. After the 1% fee, Person A earns 7% net. After 30 years, the account balance is approximately $567,000. Person B invests the same $500 per month for 30 years in a Vanguard S&P 500 index fund, charging 0.04% per year. The same gross market return of 8% before fees. After 0.04%, Person B earns 7.96% net. After 30 years, the account balance is approximately $678,000. The difference between Person A and Person B, who both invested the same amount in the same market over the same period, is approximately $111,000. That is the dollar cost of a 0.96% fee difference over 30 years. Not the cost of making bad investment choices, not the cost of bad market timing, the cost of fees alone. Now add underperformance to that equation. If the actively managed fund does not merely match the index but underperforms it by the historical average, which the SPIVA data shows is the most likely outcome, the gap grows substantially larger. If Person A's actively managed fund delivers 1.5% below the index per year on a gross basis, which is consistent with the median underperformance shown in SPIVA data, the net return after the 1% fee is approximately 5.5%. After 30 years at 5.5%, $500 per month produces approximately $430,000, compared to $678,000 in the index fund, a gap of nearly $250,000 on the same monthly investment in the same market. That $250,000 represents the combined cost of higher fees and median underperformance. It is the money that went to the fund management company instead of to your retirement. And it happened silently, without a single charge appearing on your statement. Stay with me, because this next section is where the math becomes a specific action you can take today. I am going to show you the exact funds, the exact tickers, and the exact institutions that give you market returns at near zero cost. You do not need to be a sophisticated investor to access them. You need a brokerage account and 5 minutes. Here are the specific index fund options that capture the broad market return at the lowest possible cost. Option 1. Vanguard S&P 500 ETF, ticker VOO. Expense ratio 0.03% per year. This fund holds all 500 companies in the S&P 500 in proportion to their market capitalization. It has no minimum investment when purchased as an ETF. It is the second largest ETF in the world by assets. On $100,000 invested, the annual fee is $30. $30, compared to $1,000 in a fund charging 1%. Option 2. Fidelity Zero Total Market Index Fund, ticker FZROX. Expense ratio 0.00% per year, 0. This fund covers the total U.S. stock market, not just the S&P 500, but essentially every publicly traded U.S. company. It is available only through a Fidelity account, but carries no minimum investment and no annual fee whatsoever. The annual fee on $100,000 invested, $0. Option 3. Schwab Total Stock Market Index Fund, ticker SWTSX. Expense ratio 0.03% per year. Covers the total U.S. stock market, no minimum investment. Available through a Schwab brokerage account opened free online. Option 4. iShares Core S&P 500 ETF, ticker IVV. Expense ratio 0.03% per year. Functionally identical to VOO, tracks the S&P 500, and available at any brokerage. One of the most liquid ETFs in existence. All 4 of these options are available in taxable brokerage accounts, traditional IRAs, Roth IRAs, and many 401k plans. They require no active monitoring, no rebalancing decisions based on market conditions, no research into individual companies. The only investment decision required is the initial allocation. Warren Buffett, widely considered the greatest active investor of the 20th century, stated in his 2013 letter to Berkshire Hathaway shareholders that his instructions for his estate are to put 90% of the assets in a low-cost S&P 500 index fund after he passes. He has repeated versions of this recommendation in almost every annual shareholder letter since. The most successful stock picker alive recommends that most people do not try to pick stocks. That alignment between the world's most rigorous academic research and the world's most successful practitioner investor is the clearest possible signal about where the evidence points. Here is your action plan. 5 specific steps. Step 1. Check every investment account you currently have: 401k, IRA, taxable brokerage, and find the expense ratio on every fund you own. Log into each account, click on each fund holding, and look for a line that says expense ratio or annual fee. Write every number down. Step 2. If any fund shows an expense ratio above 0.20%, search the investment menu of that account for an index fund alternative. Look specifically for the words index, S&P 500, or total market in the fund name. Compare the expense ratio. In most accounts, an index option exists that is dramatically cheaper. Step 3. If you are in a 401k and have limited fund options, email or call your HR or benefits team and ask specifically whether a lower-cost index fund can be added to the plan. Employers have a fiduciary duty under ERISA to monitor plan costs. Your written request creates a paper trail. Step 4. If you are ready to open a brokerage or IRA account, Fidelity, Vanguard, and Schwab all offer free accounts with no minimums. Open the account online. Purchase VOOFZROX, SWTSX, or IVV as your core holding. Enable automatic investment if available, so monthly contributions buy shares automatically. Step 5. Resist the urge to monitor and react to daily market movements. Index fund investing works precisely because it removes human decision-making from the equation. The research shows that investor behavior, buying high and selling low in response to market news, is itself a source of underperformance that adds to the cost of active management. Set the allocation, automate contributions, review quarterly at most. For free accounts, go to fidelity.com, vanguard.com, or schwab.com. All 3 offer commission-free trading on ETFs and index funds with no account minimums. Before we close, one final reminder. Everything in this video is educational content only. Past performance of any index or fund does not guarantee future results. All investing involves risk. Market conditions change. The SPIVA data reflects historical performance and is not a guarantee that index funds will outperform active funds in any specific future period. Please consult a qualified financial professional before making any investment decisions. But here's what I want you to take away. The 92% figure is not a talking point. It is documented data from the most rigorous independent study of its kind, updated every year, available to anyone. The fee math is not an approximation. It is compound interest applied to a real cost difference. And the solution is not complicated, not expensive, and not risky relative to what most Americans are already doing with their money. You now have the evidence. You have the specific funds. You have the 5 steps. The only thing required is the decision to stop paying for something that the data shows most people would be better off without. If this investigation gave you clarity, subscribe right now. We release content exactly like this 3 times every single week, all free, all built around evidence, not opinion. And tell me in the comments, before watching this video, did you know that 92% of actively managed funds underperform the index over 20 years? Comment yes or no. I read every comment. I will see you in the next one.